Welcome to Financial Strategies with Andrew and Daniel Adjemi, powered by the Retirement Income Store and brought to you by Adjemi Financial Strategies in Guilford, Connecticut and Denver, Colorado.
As we wind down the year, and one of the things that come to my mind is taxes. It will soon be tax time and having to take care of things. And this is we're getting almost to the end of tax planning season. Once January comes, it's too late to do any tax planning. It's all you can do is damage control. And so, Daniel, I think it's appropriate we talk about taxes today from that standpoint. When we think of taxes, I think about people that I've met along the way that have come in and they haven't done their taxes for 2, 3, sometimes 4 years, and I just can't have a hard time wrapping my mind around that. And because the IRS is not shy about drafting money out of people's accounts, and but the thing that the one idea that comes to my mind is that of a business owner who had his business in his home, and because of that, ended up taking a lot of deductions, regular home deductions as expenses on his business to a higher extent than what he should have, and so much so that his tax guy, got it down to not only did he not pay taxes, but he went below paying taxes, had more deductions. So as a result of that, he was able to do a lot of converting of IRA monies into Roth IRAs without paying any taxes. So that money was truly tax free. But the punchline here is that his tax guy retired. He ended up going to a new tax guy, and this year he ended up paying more in taxes than the guy had made in previous years because of all the things going on in his portfolio and life and that kind of thing. So it's kind of funny. But I'm Andrew Adjemi.
And I'm Daniel Adjemi, and you're listening to Financial Strategies. Today, we're talking about 5 retirement taxes you should know about in 2023. And Dad, how often is it that we see when you kick somebody out of their job for a bit of time, they go on vacation, they take some family time off, that the skeletons really start coming out of the closet? And it sounds like that gentleman there's a tax preparer. We believe that you need to pay all taxes due. Okay. You don't have to pay extra. You don't have to pay more than what you're due, but you need to pay all the taxes that are due. We're not advocating that you cheat on your taxes. That is not what we're saying. So exactly. That story was not condoned. We are saying it's good you got a new tax guy.
Yeah, right. Exactly. Exactly. And, there was one of the Supreme Court judges that in the 60s that came out and said that, it's every American's right and privilege to pay taxes, and every American's right to pay as little taxes as possible legally. Right. And that's what we are proponents of, is paying all the taxes that are due, all the legal taxes, but not more than what you're due. We don't want you to, there's plenty of other good charities to give to, rather than giving it to the IRS or the U.S. government from that standpoint. Use your money for things that can help widows and orphans and the poor and that kind of thing, rather than the government, because that's not good. But yeah, I'm pretty excited about today's show, Daniel, because it's been a while since we talked about taxes. Taxes are one of those things that are near and dear to my heart, from the standpoint of I want to give the government as little as legally possible. And there's so many times people pay more than what they have to pay. They don't think about it. It's kind of like, along the lines of how many times people are letting their money sit in the bank, sitting on the beach sipping pina coladas kind of thing, instead of having it work. And so the bankers are making a ton of money off of their money, but they're not making anything off of it. It's kind of in the same way people, pay more taxes than they have to pay, and when they could be saving taxes and giving the government, if you're liberal, think of all those conservative things the government's doing with your money, and if you're conservative, think of all those liberal things the government's doing with your money, right? So why give the government more money than what they have? And so as we look at and talk about taxes, this is a perfect time of year to be doing tax planning for 2022, as well as looking ahead to 2023. And that's what really the show is more inclined toward today, is looking toward 2023, helping people be able to understand some things that will be happening in 2023 regarding taxes. But at the same time, we want you to do some tax planning, because once January 1st comes, it's too late to do any planning for 2022. All you can do at that point is damage control. And hopefully it's not big damage, but it's damage control nonetheless. So with that, we have a paper that we had put together for this, and the paper we'd love to give you, if you want to call 800-725-7616. This paper is called 5 Retirement Taxes That You Should Know About for 2023. And you're listening to Financial Strategies with Andrew and Daniel Adjemi, because people don't know what people don't know, so they need to be educated. And a educated retiree is a stress-free retiree. And so 5 retirement taxes. Ask for it by name by calling 800-725-7616. Free, no obligation. 800-725-7616, or hit us up on the web, adjemi.com. Daniel, we got different things going on here when we talk with these taxes, right? And I want to at some point in the show talk about modified adjusted gross income, that because I think people need to understand that. But as we jump into this, one of the things that comes to my mind is the aspect of Social Security. Social Security is a payroll tax that, while we're working, comes out of our paycheck, gets set aside for us to participate in at some time in retirement. So, one of the things that's changing in 2023 is that it's going up. Payments are going up on Social Security, almost 9%, which is a great thing for those who are on Social Security. And
Too many people are retired, and they got to find some money from somewhere, huh?
Right. And Social Security is an interesting thing, because it was not, originally it was a retirement benefit, but the idea was that when people retired back then, maybe they retired at age 65, but they'd only live like a year after retirement. So retirement wasn't very long. And then it wasn't soon after that Social Security became a widows and orphans benefit, because at that time, back in the 30s, there were, primarily it was the men who were the people who were earning an income. The women were at home and they were having kids, a lot of kids. And so it was not uncommon to have minor children when you're 65 years old back then. And then if the man died, well, now there needs to be a benefit for his wife, for his children from that standpoint. So it was meant for that. And it wasn't ever meant to live on for 20, 30, 40 years. It's perfectly possible today to be able to be on Social Security longer than you actually paid into Social Security, with as long as people are living these days. So it's a crazy thing from that aspect. But we have the payroll tax, we have the money that we get from Social Security, and then we have the taxation of the Social Security at tax time, which is what I want to get into. But I don't want to usurp the show, Daniel. I want to give you an opportunity here. What do you have to say about that?
Well, I think Social Security is something that we're not really talking about receiving Social Security so much as we're talking about the taxes that are going to be increasing on your Social Security, or on your payroll taxes, right? So your paycheck is going to be going down potentially, because the amount you're paying to Social Security is going up. Now, if you're collecting Social Security, you already got the bump up earlier this year.
Okay,
You got
yeah,
about that 9% bump up, right?
Right.
And so I guess we should have expected that coming. Now, that's taking place in 2023.
Right. So January is when that comes about. So
So in January, that's going to happen. And now there's some stuff going on with Social Security that a lot of people don't know about. And this is something that we should probably touch on a bit here, where Social Security becomes taxable, and it escalates at a certain point. And we've seen people where they take $5,000 out of their IRA and it makes $10,000 taxable. Can you explain that a little bit for the listening audience?
Yes, I definitely. But I do just want to make a clarification for our listening audience. Daniel, I hate to say this, right? But, we're not talking about the payroll taxes increasing here. We're talking about the cost of living adjustment on what people are receiving. And so that will make their taxes go up because they're going to get more. And as a result of that, they'll be taxed more. So within this case of what people need to be aware of is that certain people, there's like three brackets. The lower bracket for Social Security is doesn't get taxed on Social Security because their income is so low. And then you have the upper bracket that pays full tax on 85% of Social Security. And the people that get ripped off are the people that are in the middle. The people in the middle, they're paying a little bit of tax on their Social Security. And what the issue comes in at with that is if, I've had people say, hey, Andrew, I want $5,000 out of my IRA this year. And I say, okay, fine. So we give them $5,000. Then at tax time, though, their income is not $5,000 more, it's $10,000 more for taxable purposes. And the client says, well, why is that? And I say, because it made $5,000 more of your Social Security taxable from that angle. So that you didn't get any more money. You took $5,000 out, but you're getting taxed on $10,000 more, which that is painful. And that's a kind of hidden Social Security tax, kind of hidden income tax that a lot of people are not aware of. And that when you're taking money out, whether it's because of retired minimum distributions, you're taking money out because you just need money, you're taking money out because you're retired, you need income to live on, whatever the case may be, you have to look at and take, or you take it, or you're doing converting money from IRA to Roth IRA, and you're on Social Security. You have to look at that and be aware of not getting pushed, not paying more taxes because of that. Or if you are, at least be aware that you're paying more taxes. And a lot of tax people are not, they don't do tax planning, or they don't do tax planning when you're doing your taxes with them, because all they're thinking about is the taxes, and they're preparing taxes. That's all they're doing because they're too busy with that. So you need to look at these things, and sometimes for yourself, because the tax people that you're working on are overworked, like a lot of people are, and not doing checking all the bases from that standpoint, or just don't care about telling you what it is. And so that's something that people need to be aware of. Well, I see this coming time for us to take a break. And, what we have today to give to you is a book that helps people to be able to pay less taxes. And this is called Smart Retirement. This is not something that would help for 2022, but this is something that will help for the future. And it's one of those things in here, you're going to be able to have the information that you need to be able to pay less Social Security tax in the future if you fit those brackets and that situation. So this is a great book. It's an easy read. It's not very long. We'd love to get this out to you. 800-725-7616 to the next 5 callers for your free copy of Smart Retirement by Matt Segula. 800-725-7616, or hit us up on the web, agemy.com, agemy.com, for your free copy. We'll be right back after this.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at agemy.com. That's agemy.com. Welcome back to Financial Strategies with Andrew Adjemi in Connecticut and Daniel Adjemi in Colorado.
So, 1974, thereabouts, it was when IRAs first came out. And the whole idea was, hey, if you put $2,000 into your IRA, you can not have to pay taxes on that. You'll pay less taxes now, and then you'll pay taxes later when you retire, but you'll be in a lower tax bracket. And as years have gone on, and those people who took greatest advantage of that with the baby boomers are now retiring, they found out something that's truly egregious. The IRS lied. Can you imagine that? The IRS lied. I'm Andrew Adjemi.
And I'm Daniel Edgemy, and you're listening to Financial Strategies. Today we're talking about 5 retirement taxes you should know about in 2023. And why would they do that? IRS doesn't lie. Come on.
Well, it's marketing.
What are you talking about? What are you talking about?
It's marketing, right? Marketing is presenting things in a way that make things palatable to people, right? And so this was made it very palatable. And that's where people didn't know what people didn't know. People didn't know that tax rates were going to go up, income rates were going to go up. So today what's happening is that why they lied is that many times people are not in a lower tax bracket in retirement. Some are, but that's the exception rather than the rule. In my estimation, most people are either in the same tax bracket as prior to retiring, or they go into a higher tax bracket when they retire. Why is that? Well, think about it for a minute. Some people get pensions, and then you get Social Security, and depending when you take Social Security, and if you have a spouse that's collecting Social Security, some households could be making $60,000 a year just on Social Security without pensions and other monies. And then depending how much money people have in their IRAs at 72, they have to start taking money out even if they don't need it. So, if you got $2 million in your IRA, you have to take out another 80,000. If you're already getting 60,000 from Social Security and maybe another 40,000 from pensions, now you're at $180,000 a year in retirement, and maybe you were only making 130, before you retired. So not only you're in a higher tax bracket, you're paying more taxes, and it's crazy, right? So they lied, but nevertheless, and one of what they've given us besides IRAs to put money into to do that are 401ks, and so, the new thing that's changing in 2023 regarding 401ks is that the limitations are going up. So, IRAs and such started originally at $2,000 a year to be able to put in. And then as time went on, they've increased that. 401ks increase. They have this thing that they call a catch-up provision. So if you're under 50 years old, the maximum you can put into 401ks and 403bs and such in 2022 is $20,500. In 2023, that's being increased 10% to $22,500 if you're below 50. And then if you're over 50, they have what's called a catch-up provision. And so that's going to $7,500 from $7,000 in 2022 to $7,500 in 2023. So that means somebody who's 50 years old or older in 2023 can put $30,000 away in their 401k. Now, that's $30,000 off their income, but some people have Roth 401ks available to them, which means they can put that in after tax. And when they take it out, they'll take it out tax-free, which is an alternative, something they have available.
All right. So to keep that simple, if you're over 50, you can now contribute a total of $30,000 a year into your 401k. Or Roth 401k.
Right. Correct.
All right. Let's talk about a strategy here, because this somebody might be saying, well, somebody might be sitting there and they're trying to get as much money as they can packed away for retirement. They're getting close to them. They're trying to get away, but $30,000 is just a little too much,
right,
for them to support, to have the lifestyle to have and pack all that away. So you've used some strategy. We've used some strategies over the years where people have inherited IRAs, and you have to take that out and you have to pay taxes on that. But you have some strategies, some strategies. We use some strategies where people can get that into their 401k. Do you care sharing that little strategy on the radio?
Well, it's one of our secrets there, Daniel. I mean, it's such a secret that people have a real hard time wrapping their heads around how it works. And if you can wrap your head around it, it can be very phenomenal for you and helpful for you. And yeah, okay, all right. So you twisted my arm. You can leave go of my arm, Daniel. I will give it up. I will give it up. But first, I want to just identify us as you listen to Financial Strategies with Andrew Daniel Adjemi, because people don't know what people don't know, and we want to educate you and our listening audience to be able to understand things that you don't know, so that you can make smart decisions on purpose rather than making decisions just by default. And today we have a paper that we're giving away. We're talking about taxes and tax changes and such for 2023. We have a paper titled after our show, 5 Retirement Taxes That You Should Know about for 2023. If you would like that paper, please call us at 800-725-7616, or you can check us out on the web at adjemi.com. The 2 words AgeMy, spell our last name of Adjemi, adjemi.com, and you can ask for it there as well. So, okay, so here's how it works. So let's just say you've inherited an IRA from your parents. You got $30,000 in the IRA. And $30,000 is kind of an amount, depending what's going on. It's in today's scheme, $30,000 doesn't go real far, right? It's hard to even buy a real good car for $30,000 these days, unfortunately, right? But it's nothing to be sneezed at. I mean, it's a nice inheritance. So what do you do with it? Well, if you keep it in the inherited IRA, if your parents died this year, you're going to have to have all that money out within 10 years. And pay the taxes on it. And depending how you take it out, it's up to you. You have to at least take the minimum amount out every year. But then if you take the minimum out every year, well, then at the ninth year, 10th year, whatever, you'll have to make sure that all the money is out, all the money's paid taxes on, and that's going to be taxable as you go. Well, one of the things that I talk to people about is the idea, especially if, like Daniel said, if you have a 401k, in 2023, you can put as much as $30,000 in your 401k if you're 50 or over. And let's say you're only putting $15,000 because that's all you can afford. Whatever the number is, maybe you're just putting in the maximum that they match to. Maybe that's $6,000, let's say, and you have this $30,000 IRA. You're putting in $6,000. Well, you could put $24,000 more into that 401k and to max it out for the year. So that means you could take $24,000 out of the inherited IRA that year and put it into 401k. And when you do that, that's essentially a wash in regard to taxes, because when you take it out of the 401k, it's taxable. So it goes on your taxes as taxable. But because your income was lowered by that $24,000, because you can only put money into 401ks through your paycheck. But Andrew, how am I going to live? $24,000, that's $2,000 a month. How am I going to live if I have $2,000 a month more taken out of my paycheck? Well, because you're taking the $2,000 a month out of the inherited IRA, and you're going to use that to live on, to replace the $2,000 a month that would normally be going into your checking account from your paycheck. It's going to $2,000 a month is going into your checking account from your inherited IRA. And the end result is a wash. And then next year of 2024, you could put the balance in of the $6,000, and then you get all the money out of the inherited IRA. You haven't paid tax on it. Now you can put it into your 401k, your retirement plan, and can then push it off into the future. And when they came out with the changes in 2020, for inherited IRAs, to where it was no longer being able to push it off into the future for the balance of your retirement. It limited it to 10 years. Well, now this is kind of backdoor legal way to take it out of the IRA, not pay taxes on it, put it in your retirement, and now push it off into the future. So actually your children could inherit it without paying the taxes on it until they inherit it. So that's a pretty sneak way.
Yeah, that contribution increase really helps with those kinds of things. And we've seen people do that with all kinds of money. they inherit annuity payments, right? You get $30,000 annuity payment, and you're
Right.
like, what do we do with this? Can I put it in my IRA? Can I put it in my 401k? It's too much money. Well, this is a way that you can get it in there. And just to clarify, it's just kind of taking money out instead of living off your paycheck. Now you're living off of this payment. You're living off of this distribution you took from the inherited IRA, and your paycheck is now going to max out your 401k. Why would you want to do that? Well, it gives you a lot of flexibility because now you can push RMDs off. You can't convert your inherited IRA to a Roth IRA. Well, you can convert your 401k, or you can roll your 401k over at the right time and convert it. It gives you all this flexibility. You can use it for charitable contributions and not pay any taxes on it after your RMD age. So there's a lot of different things. It allows you to decide when you're going to pay taxes and if you're going to pay taxes, compared to you're forced to take it out by a certain date.
Right.
Especially if you don't need that money. So that's something we like. It's all about the strategies, right? So these rules are good to know, so you can start coming up with strategies, or ask the right people, ask the people who you get advice from, the people who are helping you make your financial decisions. Ask them the questions and see if they know this stuff, or if you need to start advising them, right? That's why we're giving out this paper.
That's right. It's all about the strategies, folks. That's why this is called Financial Strategies with Andrew Daniel Adjemi. Strategies are key. Planning is not as important as strategies. We'll talk about that hopefully when we come back from break. But that's the idea, these strategies that can work for you to give you more options, to give you more flexibility, because it's your money and you should be able to do with it what you want, as opposed to doing what the crowd does or what the government wants you to do. So you're listening to Financial Strategies with Andrew Daniel Adjemi, because people don't know what people don't know. We believe an educated retiree is a stress-free retiree. So with that, we've given away a book. We're going to have to go to break. That went fast. The book, Smart Retirement, for those that want to understand how they can pay little to no tax on their investments going into the future and still have the money invested safely and growing at a good rate compared to the banks, at least, and without risk. So lower taxes, safe money, and being able to take advantage of flexibility with that at the same time. You can have this book for free, Smart Retirement, by calling 800-725-7616 to the next 5 callers, 800-725-7616. We'll be right back after this.
History tells us the market goes up and the market goes down. What would you do if you lost half of your retirement savings? It's time to make the shift to steady, reliable retirement income. And where do you go? The Retirement Income Store. Log on to Adjemi.com for your free retirement review. That's AGEMY.com. The Retirement Income Store, where retirees go for income.
Welcome back to Financial Strategies with Andrew Adjemi in Connecticut and Daniel Adjemi in Colorado.
Hey, Dad, I was talking to a guy yesterday, and this comes up all the time, but we're talking about Roth conversions, and he was really worried about when he turned 72, although he thought it was 70 and a half, because the required minimum distribution age used to be 70 and a half, now it's 72, that he was not going to do, he could only do Roth conversions up until he turned required minimum distribution age. And then he couldn't do them anymore. And there's a lot of people that have these misconceptions about Roth conversions, about limits to Roth conversions, about when they can and can't do them. So we were able to go through all the different parameters with him, and he decided he wants to start doing some Roth conversions before he's 72, before he's retirement age, or required minimum distribution age, and then maybe keep doing them and using the taxes from them, using the required minimum distribution to pay the taxes on the conversions later on down the road. And so we were able to go through these things, but people have a real hard time getting their heads wrapped around these Roth conversions.
Right.
I'm Daniel Adjemi.
I'm Andrew Adjemi. You're listening to Financial Strategies with Andrew Daniel Adjemi, because people don't know what people don't know. We're glad that you're joining us today. We're talking about taxes and tax changes for 2023, 5 retirement taxes that you should know about for 2023. And we've talked about so far the aspect of Social Security, being the payments being increased on Social Security to people who are collecting it, but the taxation that hits that. We talk about 401ks and how the limits have increased on that so that you don't have to pay as much taxes now on that, or you get the stuff more into your Roth 401k. And now Daniel, you're talking about conversion and so forth. One of the things that comes to my mind when you're talking about that is, there's 2 ways to get money into Roths. One is to make contributions. And you can only make a contribution if you have earned income. As long as you have earned income is stuff that you get a W-2 for, stuff that you pay taxes. Social Security is not earned income. Money out of your 401k, IRA, Roth, that kind of thing is not earned income, but money that you actually go to work for, get a paycheck for. You have 75. You have money that you make from that. You can put that into a Roth as a contribution. The other way to get money into a Roth is through a conversion, like you were talking about, Daniel, right? And taking IRA money, paying the taxes on it, converting it to Roth IRA, putting it in a Roth IRA. Then you never pay taxes again. That's the advantage. Once you paid the taxes, you never pay taxes again. So what's changing for 2023, Daniel?
Well, the limits, right? The limits on IRA contributions are increasing. On Roth IRAs as well, right? So these things work the same. If you're under 50, used to be $6,000 a year. Now it's $6,500 a year. And if you're over 50, then you get a catch-up contribution, which is $1,000. So the catch-up contribution hasn't changed. It's still $1,000. But that means now in 2022, if you're over than 50, you could contribute $7,000, and now you get to contribute $7,500, which isn't a lot, but I mean, it's crazy to me to think about. You're talking about $2,000, and some people still have that in their heads, like those things that you save for retirement, those things that the IRS lets you do, that you can put $2,000 a year into. I've heard people say that exact thing. And it's gone up quite a bit. And the $500 a year doesn't sound like a big increase, but that's 25% of what it started out as.
Right.
So that's huge. I mean, that's huge. And jumping around a little bit, going back to those Roths, people have a difficult time. Some people just get it and they want to do Roths. They don't care what it is. And some people have a difficult time because they want to analyze, well, when's the break-even point? When do I break it? And that's such a hard thing to figure out because you don't know what's going to happen. Most people don't know what's going to happen, right?
Mm-hmm. Right.
Now, you can change your investments around so they're more certain, and you can figure it out, and it makes it it gives you a lot more warm feelings. But think about this. Think about how much all you had to do. If you're 60 or older, all you had to do was put money in any stock, basically the stock market, any house, right? And you're doing pretty good. You made a lot of money. If you did that, you made a lot of money, right?
Right.
You got $1 million in your IRA. You got all this money. Now, think about how much taxes you're going to have to pay on that. Now, a Roth IRA wasn't available when you started investing.
Right.
But that's what we're talking about. Could you imagine if that was all tax-free? Now you're talking about $1 million IRA, $2 million IRA, and you're talking about drawing $60,000, $120,000, $140,000 if it's $1 million or $2 million IRA of dividends only, tax-free. Can you imagine that? That means if you don't have a pension or anything,
yeah,
you're not paying any taxes on your Social Security because, right?
Yeah, right. That's right.
Because now your income off your Roth there's no tax.
That's right. You
So
got it
we can do
right.
some pretty cool things. Now that's just a rant. That's not what we're getting into right at this point. But that's what came to mind, especially with those little contributions you're talking about. When it started, it was $2,000 a year. That's a big deal. That now it's up. If you're over 50, that's up to $7,500 a year for 2023.
That's huge, Daniel, because it hadn't really increased. I think within into the 2000s. I don't remember when they first started increasing it from 2000 up, but it wasn't until the 2000s, I believe, that they did that. But anyway, you're listening to Financial Strategies with Andrew and Daniel Adjemi, because people don't know what people don't know. Today's topic is the 5 retirement taxes that you should know about for 2023. We've talked about 401k limits have increased, talked about Social Security and how that's taxed and how the income is doing. We talked about IRA contributions limits increasing for both IRAs as well as Roths. But we have this paper that we put together today. We love to put in your hands. So 5 retirement taxes that you should know about for 2023. Call us at 800-725-7616. So for your free copy, no obligation, or hit us up on the web at agemi.com, agemy.com. I also want to take this opportunity to let you know that that this recording goes to a podcast. Anywhere you listen to podcasts, you'll be able to listen to this again. Or we also have a YouTube channel where you can actually see us as we record this thing and see what we look like and whatnot. But anyway, this is available to you, and you're listening to Adjemi. You listen to Financial Strategies with Andrew and Daniel Adjemi. Contribution limits going up to $7,500 for IRAs in 2023, Daniel, whether that's a traditional IRA or that's a Roth IRA. One of the things that people may not know, one of the things that keeps people from investing into Roth IRAs, contributing to Roth IRAs, is that they make too much money. Mm-hmm. And so they're above the limits where they cannot do that. They can't contribute to the Roth IRA. One of those things, the limits for a single person in 2023 are going up to, it starts at a point and then it starts to phase out, right? So at a certain limit. So I'm just going to make it simple. And you can contribute the full in 2023, $7,500 if you're making less than $138,000 a year. What that does is, and that's for a single household. What that does is that if you're making more than that, well, you're not going to be able to contribute to a Roth IRA, which is problematic. If you want to do that, well, there's a way around that. It's a higher number for people who are married, but still, if you're making too much, you can't contribute. Well, there's a legal way currently around that, and the IRS is wanting to eliminate this, but it is available, which we call it the backdoor Roth, where you put $7,500 into an IRA, what's called a non-deductible IRA. So you put it in, you don't take any deduction on it, and then you convert it into a Roth from there. You pay no taxes because you had no deduction. You had already paid taxes on it, but now you get it into your Roth legally from that standpoint. So that's available to some. You need to check with your tax counsel on that, because we've come across tax counsels that don't like that idea, but we've come across tax counsels that do like that idea. So that's something that may be available, and another strategy to help you stuff money away on a tax-free basis.
And so that non-deductible IRA, that works. That's what you would need to do if you were over the threshold, right? For 2023, these thresholds are going up. So for singles to contribute to a Roth IRA, you need to be making less than $138,000. And if you are, if you're filing jointly, it looks like it's about $153,000. So if you wanted to get money in, there's 2 ways you could do it other than that to a Roth, right? Well, I guess they're both kind of the same way. It's conversion, right? It's a conversion. One is you're just converting taxable IRA money, and you pay the taxes, and you can do as much as you want You can, as long as you want to pay the tax on that and you have the money in your current IRA, you can convert that, get that into a Roth, or you can do what you were talking about, where you make a non-deductible IRA contribution and you don't claim it, because if you claim it, then it doesn't count anymore. You got to pay taxes on it. And it's the same as the first way we were talking about. So you make that, you don't claim it, and then you convert it right away before you earn anything on it. But like you said, you need to talk to your tax professional for that. The other reason you would use a non-deductible IRA is because you have a current employer-sponsored plan and you make too much money to contribute to an IRA, right? And so there's limits around that. And so those phase out limits have changed as well. So you've seen people do that. What are the benefits of contributing to a non-deductible IRA besides converting it right away?
Well, the money that you put in, you don't get a tax break on the money that you put in, but you don't pay the taxes as the money is growing. And when you take it out, when you're 59 and a half or older, you'll pay taxes only on the growth, not on the principal. Now, unless in my mind, with the limitations and so forth on that, if you're going to do something like that, you're probably better off in an annuity, because that's going to do a similar thing from that standpoint, as far as you allow your money to grow tax deferred into the future, and you don't have the limitations about how much you can put in to that. And then you could use your non-deductible IRA to contribute to a Roth IRA from that angle if you wanted to. But that's the idea behind us. A lot of people today don't know about non-deductible IRAs, don't use non-deductible IRAs. But in the past, what people did was they were told by their tech guy, you can no longer contribute and have this deductible. So if you're going to put it in, it's not going to be deductible. Or maybe they weren't even told that. And that's what happened, is that they actually paying double tax on the money is what they'll do, because they weren't told that and didn't know that. So that's another situation, right? But I see that it's coming up time for us to take a break. And you're listening to Financial Strategies with Andrew Daniel Adjemi, because people don't know what people don't know. And this is all about educating you, the consumer, to be able to be a smart, educated consumer, because an educated retiree is a happy and stress-free retiree. We have this book for you. We'd love to give to you to help you understand how to pay less taxes in the future. Maybe taking your RMD, using your required minimum distribution to put into this and never paying tax on it again, or whatever. But it's called Smart Retirement, easy read book. Love to put this in your hands. No obligation to the next 5 callers at 800-725-7616. Call now.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at Adjemi.com. That's AGEMY.com. Welcome back to Financial Strategies with Andrew Adjemi in Connecticut and Daniel Adjemi in Colorado.
It's been decades, Daniel, decades that we've seen inflation the way that we're having inflation hit us right now. It's been a little less than 2 years ago, right? Gasoline, was, half of what it is today, basically. Yesterday, my wife went to the store to pick up some eggs, and she said, Andrew, do you know how much a dozen and a half eggs are costing now? Over $9. $9 for over a dozen and a half eggs. I'm Andrew Adjemi.
And I'm Daniel Adjemi, and you're listening to Financial Strategies. Today, we are talking about 5 retirement taxations you should know about for 23. And what does inflation have to do with these 5 things? We talked about Social Security. We talked about the new contribution limits on 401ks. talked about the new contribution limits on IRAs and Roth IRAs. We talked about Roths and the phase out ranges. Um, and we have not talked about the income phase out range on traditionals yet. But what does inflation have to do with all this?
Well, uh, the inflation has to do with what we're spending, our spending power. And when is, $1,000 not $1,000? Well, when you have to pay tax on it, right? Because if you take $1,000 out of your IRA and you have to pay tax, you end up with $700. So that digs in. And now, eggs are costing $9 for a dozen and a half eggs, and gasoline's costing $4 a gallon, and diesel's costing $6 a gallon, all these kinds of things. Well, that's hard to do. But if you were able to take $1,000 out and have a true $1,000, that would be a wonderful and beautiful thing. Well, that's the same effect that taxes, taxes have this draining effect, have an inflation effect upon our income. And that's where it's so important to be able to pay as little taxes as legally possible. And when people can understand this and how to do this, they can be in a better position to be more tax free. This is a huge thing when people are dealing with these things. And one of the things when we're talking about this is what's called modified adjusted gross income. People are used to gross income. They're used to the terminology of adjusted gross income on your tax return, that, you come down to adjusted gross income, then you take your either standard deduction or your itemized deductions off of that, and then you have the taxable income after that. But the modified adjusted gross income is a thing that people need to be aware of, because when we're talking the phase outs of Roth IRAs, IRA contributions, all these different things, the modified adjusted gross income comes into play. We did a Roth conversion. We're doing it right now. We're doing a Roth conversion for somebody, and you were doing the calculations, and we have to look at what the modified adjusted gross income is to make sure that they stay below the limits of before they get extra taxation or have to pay more for for their Obamacare. So modified adjusted gross income is an important thing to take a look at. And what happens with a modified adjusted gross income? What do they do to your adjusted gross income, Daniel, to make it the modified adjusted gross income?
Yeah, it's kind of a weird thing because it's not on the tax return.
Right.
And so it's a little bit weird, and it's weird when you have tax-free things. So like you have to add in special credits, you have to add back in tax-free interest. So it can get tricky, and that's why it's important to know about it. You don't have to know how to figure it out, but you have to at least ask about it, because you want to make sure that you're not going over these types of limits, or if you go over it because you're like, my income's down, but then you go over it because they added the non-taxable part of your Social Security back into the calculation. Now all of a sudden your healthcare credit goes away, right?
Yeah, right.
Because nobody thought, oh, well, we have to add back in the non-taxable part of Social Security, and those non-taxable bond interest we received, all that has to get added back in. And I think I'm missing something else that gets added back in.
Well, IRAs
that most people.
IRA deductions get added back in. So if you contributed to an IRA, that gets put back in, right? And then other deductions can get put back in as well, like your standard deduction and some of the itemized deductions, different things like that. It's an interesting thing because sometimes losses are still attributed to it. So it's a funky thing that you have to be careful of if what you're dealing with is modified adjusted gross. So where that comes into play with this is when we're talking about phase out limits for Roth IRAs and IRA contributions. Basically, the idea here is that when you're talking those phase out limits, they're talking modified adjusted gross income, not just taxable income. So that's where sometimes it takes a tax software or somebody that understands how to do this stuff, a professional to be able to put that together for you to be able to know where those limits are. And you may contribute or do some things that may end up hurting you in the long run if you're not aware of these things. And, when we're talking about this, the limitations are going up for IRA phase outs. Daniel, you want to tell us about that?
Yeah, well, this is important to people who have employer sponsored plans. So they're contributing into their IRA or their 401k at work, maybe their Roth at work, and they make a certain amount of money, and they're maxing that out, and they want to make another contribution. They want to contribute to their IRA, get some more tax deduction in their personal account. And so those limits, I don't think a lot of people run into this, but there's some people who make a good amount of money and they want to make another contribution to their IRA.
Right.
And it looks like these limits are going for couples filing jointly. They're pretty low. If you both are working, you both have 401ks at work, the range is moving from 116,000 to 136. So that's a pretty big jump. So we'll just talk about the 136,000. That means if your modified adjusted gross income is 136,000 and you are both have 401ks available to you at work, you have to be earning less than that number to also contribute to a IRA. Pretty simple there. That's why we were talking earlier about the non-deductible, because you could put money into a non-deductible IRA in that situation. But why? Right? Like unless you're converting it. So that's what we've seen. People who earn a lot of money, we've seen them put into a non-deductible IRA and then convert it immediately over into a Roth. But other than that, there's a lot of other things. You could do a rich man's Roth. You could do an annuity, like you had mentioned. There's other things you could probably more wisely use that money for with less bookkeeping, right? Because there's a lot of bookkeeping that has to go into
definitely
these non-deductibles, as well as the other rules you have to abide when you have to take money out, how much you can put in, limits to this, limits to that. It's just simpler to do some other types of investing, and still you could get that tax deferred status or maybe a tax-free status depending how you use the money.
Yeah, exactly, and that's a great point. As the bookkeeping is egregious on the non-deductible IRA, whereas if you use like an annuity or one of the other things that you're talking about, the companies where you're investing the money are doing the bookkeeping for you, so that it's much cleaner and easier from that. But and you brought up a good point, Daniel, about the limitations for people putting into IRAs or Roth IRAs if they have a retirement plan at work. If they both have a retirement plan, right, you can put, it's a lower limit than if one has a retirement plan and the other doesn't have the retirement plan. So you have some options available if one of the spouses doesn't have a retirement plan. Even if the spouse is not working outside the home, you have some options. You can still contribute to an IRA potentially if they fit the limitations, even though the other spouse has a 401k or pension plan or whatever at work. So there's a lot of there's a lot of things and variables and innuendos here with this that you can be careful about and need to be careful about, but need to look at as we wind down 2022 and start looking at 2023 and get those if you're able to maximize your contributions to the 401ks, pushing it up to, if you're over 50 years old, $30,000 a year, and increase on that. Daniel, we have just a couple minutes left in the show. I think we hit those points well in that, for what we're trying to do today. Where do you want to leave things with these people?
Well, we've been on a big training kick here at Agimi Financial, right? We've been working on taking time, do things the right way the first time, because that saying that goes, you never have time to do it right the first time, but you always have time to do it again. Somehow that works. That's not how you want to set up your retirement. You don't want to have to. Don't save up at the beginning. Don't know about these things and have consequences down the road. You don't want to be like doing these contributions when you don't qualify and then find out that this IRA you thought was an IRA is now a non-deductible IRA or something like that. So these are things to take the time, talk to people who know what they're talking about. Ask your CPA about these things. Make sure you're doing it the right way. Talk to your advisor. If your advisor doesn't know what they're talking about, talk to an advisor who does know what they're talking about. If you're your advisor, do some reading, go take some classes. These are things to understand, to pay attention to, because it sounds simple, and they are. As long as you do them before it causes the problem. And that's always what people get tripped up on, right?
Right.
There's that curve. It looks like this. It goes straight up, and then it shoots straight down like this, and then it comes up like that. And this peak right at the beginning, they call that Stupidville, right? Because when you're learning something new or you don't know anything about something and you gather some information, you feel really smart right at that part. Before you start learning more and you start realizing you don't know what you don't know, right? You just feel like the smartest person alive at that point. And then you drop off that cliff and you're like, what was I thinking? I thought I knew everything, right? And so watch out for that. When you get a little bit of information, I'm enough to make me dangerous. That means you're about starting to come down that cliff where you start knowing, I don't know as much as I thought I know. I know I need to start asking questions. And that's what this show is about, to help people ask the questions and test yourself, see where you are on that learning curve.
Yeah, that's excellent, Daniel. And, that's why we have the show. You're listening to Financial Strategies with Andrew and Daniel Adjemi, because people don't know what people don't know. And we want to help you and educate you. And an educated retiree is a stress-free retiree. We have this book that we want to educate you with. If you want to be a self-learner, Smart Retirement. Oh, one of the things I want to say to you is that, Daniel was talking about talking to your CPA. If you don't have a CPA, don't have a tax preparer. Well, we also have a tax preparation company, tax planning company. Connecticut Sound Tax Group is our tax preparation, tax planning company, and we can help you with things if you don't have somebody to do that. And, we're coming up to tax season. And if you want us to be able to help you with your taxes, we charge a very nominal fee for being able to do taxes, much less than the going rate for any of the big name companies out there and whatnot. So glad to be able to help you with that as a service to you and our radio audience. So anyway, we're giving away this book, Smart Retirement. Easy read. Love to put it in your hands. Call us 800-725-7616 for the next 5 callers. 800-725-7616. Call now. Until next time, remember, if you want to have a stress-free retirement, invest for the I and not the G.